From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde, and this is Bloomberg Technology. Tariffs, they hit global tech stocks again today as China retaliates and imposes tariffs on all American imports and withholds crucial rare earths. $2 trillion wiped off the Nasdaq 100 in 2 days alone. That's as the benchmark is set to enter a bear market. Investors now expecting the Federal Reserve to cut interest rates 4 times this year. We will hear from the Fed Chair, Jerome Powell, later this hour. But we've got to dive into the Nasdaq 100's move. Ran Vlastelica is here. Extraordinary. We haven't seen this sort of sell-off since 2020.
Absolutely. The scale of the weakness has been pretty, breathtaking. The size of the drops, just the broad-based nature of the sell-off. It's been pretty remarkable.
What's also remarkable is how much we start to see the ongoing retaliation, whether it be from countries such as China and the impact that will have on being able to make technology products here in the United States, but individual companies later will be shining a light on Nintendo. It reports that they're going to be delaying their switch to pre-orders to the US. All of this, is it yet priced in, Ryan? What are analysts telling you?
Well, what I've heard so far is that there's just so much uncertainty out there that few people are really willing to jump in right now. I mean, some people remain positive on a longer-term basis. They say if you have a 3 to 5 year time horizon, maybe you can take advantage of some of the drops in some of these names. But we don't really know what to expect. I mean, yesterday, things were really bad. They're even worse today. We had China retaliate. Is there going to be a response to that? Some kind of back and forth? We just don't know. And that makes it extremely difficult for companies to know how to plan, and that makes it extremely difficult for investors to know how to position.
And at the moment, just where in particular are the pain most acute? It's hardware rather than software, but software still in the eye of the storm if indeed the EU decides to respond from a digital services tax perspective.
Yeah, absolutely. So far, we saw a little bit of relative outperformance in software, especially yesterday. Some people were telling me maybe this is too much, too fast for software because they're not as directly exposed to tariffs as other part of the market. But certainly hardware, like you mentioned, very much getting hit with this. It's extremely, there's a lot of manufacturing exposure to China, to Vietnam, to places that really got hit with tariffs. That's places really suffering, over the past couple of days in particular. Chips have really come in quite a bit. There's still, like I said, a lot of uncertainty. People were already concerned about what is the outlook for AI spending. People were already talking about valuations maybe being elevated. All of these things are just dovetailing, and it's just you have a lot of reasons to be selling right now and very few reasons to be buying.
Worst case scenario is the lead quote in your story coming from a particular investment, the CIO of Granite Bay Wealth Management. Do we think there's a movement back from this worst case scenario? There have been many calling for the fact that Apple might get some sort of exclusion from the tariffs longer term. Are many bracing for just headline risks going forward?
I think there's a lot of bracing for headline risk. There's been a lot of hope that Apple would get an exemption the way it did in the first Trump administration. But this is a very different kind of trade war, very different tariff policies than we saw in the first administration. So there's not really much of a playbook that you can use here in the same way, you might have thought, well, it wasn't that bad, 8 years ago or whatever that was. It's looking like a lot more severe right now. And that, again, just makes it harder for people to know how to allocate, how to position, if they should be bracing for more short-term pain, if this looks like a long-term buying opportunity. There's just so many questions right now. It's hard to know really what to do. That's what people are telling me.
Get back to the phones, I'm sure, and the email. Ran Vlastelica, thank you so much for spending time with us. Look, let's turn to individual stocks. Tesla, for example, trading lower, unsurprisingly. In fact, it's down 15% in the last 2 days following tariff news, its own deliveries missed. Interestingly, JPMorgan want to shine a light on their perspective. They've cut their estimates further on the stock, quoting what they see as unprecedented brand damage. Bloomberg's Craig Trudell joins us for more. And we had been deciding whether this was production issues, whether this was the lack of a new model. But for JPMorgan, this is brand damage.
Yeah, and I do think it's both, right? But of course, JPMorgan, as one of the more bearish analysts or bearish brokers on the street, they have very much sort of leaned into this idea that this is more than just the Model Y changeover, which, we should note is a significant issue in the first quarter. And it remains to be seen just how much, Tesla can sort of overcome any brand damage that is an issue here. But it is, hard to sort of think of an equivalent moment for a car brand where you see people, throwing paint onto showrooms and lighting cars on fire. This is just, very unusual for any product, but particularly for cars where, this is the second most valuable thing that people buy right after their home. So, to buy a Tesla now means something a lot different than it did, only months ago. And, there are real questions about just how much sort of lasting impact Musk's, entry into politics is going to have on this brand.
You cite, of course, JPMorgan being one of the more bearish on the street, and they've got a price target of just 120. But you go to the more optimistic, the bullish on the street, Dan Ives of Wedbush, $550 price target on Tesla. Even he is saying the recent report, the deliveries one, a disaster on every metric. Is there any view that Elon Musk potentially starting to ease out of what the White House and his day-to-day roles, as has been reported? Of course, they push back against that. But whether or not he will come back to the fold, refocus on Tesla, and that being an optimistic light?
I think if we listen to what Musk is saying and what even, J.D. Vance has said, I just, have a hard time sort of seeing, Elon sort of heading to the back seat, if you will. That's not very much his nature, right? He has very much, sort of gotten in deep with this administration. Just in the last few days, he was pictured with a, Trump, everything Trump said was right hat. I may be, getting the verbiage a little off, but he is very much, behind the president. And sort of one in the same with this administration. And even if he does, take a step back officially, I think, it's hard to sort of fathom how he could really sort of separate himself after he's thrown himself in so emphatically the last, 6 months.
Craig Trudell, who's been following this for 6 months and then some, we thank you. Look, the market onslaught, it continues for other names. Let's look at Apple. Their market cap slipping now below $3 trillion. Let's get to a key analyst on the stock, Apple, Gil Luria, D.A. Davidson, Managing Director, joining us now. You look at so many names, and I'm excited to talk to you about all of them, Gil. But let's just focus in on Apple at the moment and what extent is being priced in the supply chain upending and indeed the tariff impact. Will they get some sort of exclusion, do you think?
It looks less likely now that they'll get an exclusion than last time. I think that commentary is probably correct. The market is doing its best to assess the impact on Apple. Right now, it's just doing the rough math. A third of the revenue being impacted, about a third tariffs higher, one times another, the stock is down about 10 to 15%. That's as good as the market can do right now. We're going to have a few days and weeks to refine that math as we see how this plays out. But the structural change to the United States' role in the global economy has already happened now. And every day and week that we proceed in this direction, it's going to be cemented as a different world order. And therefore, we have to get better at doing the math about how that impacts companies like Apple, but also a lot of other technology and other companies.
There are so many headlines coming out minute by minute, Gil. And one of them, we understand President Trump is saying that Vietnam wants to cut their tariffs down to zero. Now, Vietnam has become a relatively new hub for Apple. How are they able to, in this moment where the news can change from day to day, able to stomach the higher costs? Because they have a healthy margin of about 46 to 49%.
That's right. So Apple has a few levers. One, it can push cost increases to its suppliers. Two, it can pass through price increases to its consumers. And then three, it can absorb some of the margin degradation. So it has all three levers. In the short term, it's going to use all of those. But to your point, in the medium to long term, it has the ability to shift production. It's already started shifting production from China to India and Vietnam, who are far likely to arrive at a beneficial agreement with the United States about tariffs and trade than China is.
Yeah.
So the fact that Apple's already manufacturing in India and Vietnam gives them medium-term and definitely longer-term flexibility to offset some of the tariff increases and reduce the impact on prices and margins.
Gil, that's the hardware perspective, and I can understand why in NVIDIA that you also look at his feeling the pain on a hardware perspective and getting product out of Asia. Meta, under significant pressure, why? Is that more about the EU response mechanism?
That's part of it. Part of it is that in an economic recession, there's less advertising dollars, which will mean less digital advertising, which is really all of Meta's business. So that's part of the reaction. Part of the reaction is Europeans have a habit of drawing funds out of our large technology companies through non-tariff barriers. So they'll decide that Meta isn't doing a good enough job on privacy, so they'll limit Meta, they'll fine them billions of dollars. They've done the same to Google, they've done the same to Apple. And so the more we get in conflict with Europe, that's a lot of the lever that the Europeans have.
Right.
It's not just tariffs on goods, it's the Europeans' inclination to put in regulation that restricts these companies and allows the Europeans to fine them billions of dollars.
Talking of levers, President Trump thinks he's got a lever when it comes to TikTok and China tariffs. Just, you cover Oracle. In any capacity, do you want to see Oracle become a minority holder of future shares in a US TikTok, if indeed that deal that seems to be being discussed with the White House goes through?
Somebody's going to get a windfall from this. The TikTok US business is incredibly valuable. And to the extent we can accomplish the national security goal of not allowing our data to be sent to the Communist Party in China, that business is incredibly valuable. And whoever gets to participate in it is going to get a windfall. It looks like Oracle may be in the running to do that, but everybody else is running for that too. It's incredibly valuable because if you think about it, there's only really 3 venues for social media where you can access consumers: Google's YouTube, Meta's properties, and ByteDance's TikTok. And whoever owns TikTok in the US will have a very valuable asset. And to extent Oracle can expand its business, it already has a TikTok business in hosting.
Yeah.
If it can expand more into an operations role with TikTok, that would be a windfall to Oracle.
There's got to be some people winning in certain circumstances. Gil Luria of D.A. Davidson, we thank you for your real expertise. Let's just go to more breaking headlines right now, because President Trump is indeed speaking. We understand that he says it's perfect time for Chair of the Fed, Powell, to cut interest rates. Remember, we're hearing from Fed Chairman in but 10, 15 minutes' time. He is speaking at an event in Arlington, Virginia, among other journalists. And we understand that Trump is saying that Powell is always late, but this is the perfect time for Powell to cut interest rates. The market currently factors in 4 interest rates cuts for this year. Let's take a look at some other companies that are being moved around via tariffs. Nintendo, for example, check in on its US ADRs. The stock, as you see, falling, currently 3.3% intraday. There are reports out there that the company is set to delay its US pre-orders of the Nintendo Switch 2 because of tariffs. The product launch date is still set to remain on June 5th. Coming up, Vice President J.D. Vance says a deal for TikTok will come out before the deadline for its potential ban. That deadline is tomorrow. We'll discuss that next. This is Bloomberg Technology. Breaking news in response to the market turmoil. News on Klarna. The company is said to be delaying its planned IPO after the implementation of Trump's tariffs. That's all according to the Wall Street Journal. We'll bring you any more breaking news on Klarna and its planned IPO, but as we understand from the Wall Street Journal, it's pausing its plan for initial public offering. Meanwhile, Saturday is the deadline for ByteDance to find a buyer for its US TikTok holding or be banned. President Trump and Vice President J.D. Vance have both signaled that a deal is within reach. Bloomberg's Kurt Wagner joins us for more. And maybe a deal even before Saturday the 5th?
I would be surprised if we don't have something before Saturday. It's either going to be an announcement of a deal or a proposed deal, I should say, because, again, this requires buy-in from the Chinese government and ByteDance, which I don't believe we have yet, or an extension to continue discussing a deal, right? But we know that this week the Trump administration was meeting to talk about a specific deal that involves Oracle, Blackstone, and a handful of other investors. I think we're really circling around something that looks like that, and I expect we'll have something before midnight Eastern tonight, which, as you pointed out, is when this ban is supposed to kick in if they don't do something.
The deal is all very well and good depending on who's agreed on it. And I suppose that the US investors might be aligned. But do we understand if ByteDance and the Chinese government might be aligned, considering they've just unveiled further tariffs in response to the US ones?
Yeah, that timing is not necessarily a strong sign that everyone is working together here. We have not heard from ByteDance. We have not heard from the Chinese government. My understanding is that the U.S. side of this equation is working to propose something that then they hope will be accepted on the other side of the fence there. But as you point out, we're in the middle of this global trade war right now, particularly with China. And so Trump has suggested, well, hey, maybe the tariffs come into, are a negotiating bargaining chip in this whole thing, but it is a complicated situation because of what you just mentioned.
And what's also complicated is what happens to the algorithm and what oversight Oracle and indeed US investors ultimately have, and whether that's in line with the letter of the law. 2024 law passed, didn't have much way in which the algorithm could be kept in Chinese hands.
That's right. So by letter of the law, the Chinese tech company ByteDance or the Chinese government should have essentially zero influence or control over this algorithm. The deal that has been proposed seems to suggest that they would. And so the deal that is being discussed may not follow the law. Now, the question is there someone who's going to challenge President Trump on that, right? If he just simply says, this is acceptable to me, we're going to do it, is Congress going to step in and say, hey, look, this doesn't follow the law, we're going to challenge you, or are they going to let it slide? And I don't know the answer to that. But I think you bring up the stickiest point in this whole thing, which is the actual control over this key technology. Both sides want it, and I'm not sure how they're going to rectify that.
Bloomberg's Kurt Wagner, staying on top of a very timely conversation. We thank you. Let's focus now in on what advertisers, marketers do in this moment. Do they go to TikTok or not? Rachel Tipograph is with us, founder and CEO of MikMak. You have the data. And since January 19th, which was the first deadline when we were worried it was going to be banned and it went black for a moment, traffic has recovered to TikTok, right?
Absolutely. So January 19th, I was here with you. We saw TikTok traffic go to zero. It took about until March 1st for TikTok traffic from major advertisers to reach Q4 levels. Why? There was a lot of confusion if it was still legal to advertise on TikTok. And if you've been following, TikTok did a lot of advertising themselves to communicate this is a safe place for you to advertise. Here we are, and we're now seeing TikTok traffic surpass Q4 levels. So MikMak tracks 2,300 of the biggest brands in the world, and our traffic on TikTok right now is 20% higher than Q4 levels.
That's pretty phenomenal considering the level of uncertainty going into this Saturday. Is there likelihood that people are paring back just into this one-off event?
We haven't seen that yet. And the reality is TikTok is a very unique asset. It's why we have the US and China fighting over it. You can build brand and drive conversion all at once. So until US advertisers hear that they shouldn't be advertising on that platform, I believe that they will continue to do so. That being said, they all have contingency plans. They have contingency plans for tariffs, and now they have contingency plans for advertising. And what we saw around January 19th is how easy it is to move dollars from one platform to another.
Where did it go? Where did it shift? Who benefited?
So the two big beneficiaries were Alphabet. So Alphabet is paid search, YouTube, DV360, and Pinterest. In both of those platforms, you can drive conversion, and brands consider it a brand-safe environment.
Is that why they're not going to Meta? Why did Instagram not become the automatic place you put yet more advertising dollars, or is everyone already there?
So the interesting thing about Meta is it is the gorilla. It's the giant. On any given day at MikMak, it's our #1 source of traffic, and it remains to be so. That being said, when we compare Q1 to Q4 Meta traffic, we've seen a 3% decline. And when we look at the timing of this, it's all around Zuckerberg's announcement of removing fact-checking from the platform. So it goes back to many of the things that brands are balancing right now, and one of them is concerns around brand safety.
That's really interesting. And I'm wondering, therefore, also at this moment, we're seeing Meta stock under pressure significantly because people are worried that advertisers are going to pare back because of economic uncertainty, let alone brand certainty and safety. Is that something you're preparing yourself for?
Absolutely. I mean, this is a whole other curveball. This isn't about TikTok or Meta or the trade desk. This is about tariffs and consumer goods. And the reality is, consumer good companies are in a really tough spot. Their margins are getting squeezed, and they really only have three options. Raise prices, which retailers and consumers don't want that. The second is reduce supply chain, so essentially produce fewer SKUs. I can tell you advertisers are not going to want that. Why? What creates advertising revenue to rise? Auction density. You need more SKUs. And then finally, the worst thing, which is what I think the markets are reacting to, is removing working media spend altogether. And I can tell you, if you're a student of brand the way that I am, if you stop investing in brand, you will lose market share. Right. And every CMO and CFO across the world right now is having this conversation.
Worried about tariffs. Going back to TikTok, though, in 30 seconds, if TikTok isn't bought by the Oracle contingent and we don't see the algorithm come to US hands, do people stick with it?
I think that you're going to start to see dollars shift very quickly then, and they'll shift into platforms like Alphabet and Pinterest.
Always great having Mick Pack's data. Rachel Tipograph, a joy to have you on. Thank you. Look, we've got more breaking news in response to the tariffs. This one is StubHub's IPO. We understand, according to the Wall Street Journal, that StubHub has also delayed its plans for initial public offering. Remember, there's the likes of StubHub who are in potentially coming to the market. We also have Klarna delaying, according to the Wall Street Journal. The ripple effects being felt far and wide. Coming up, we're going to be hearing from the Fed Chair Jerome Powell in the midst of this market uncertainty following widespread tariffs, reaction from China. That's next, and this is Bloomberg Technology. US jobs growth actually beat forecasts in March, pointing to a healthy labor market. This, of course, before the global economy gets hit by widespread tariffs. Bloomberg's Mike McKee is here to break down what looks resilient before, of course, this wall of worry.
Well, actually, the labor market is good news, but we now have the headlines breaking from Jay Powell's speech in Washington, and he is saying that the effects of the tariffs are probably going to be stronger than people anticipated, than the Fed anticipated. Inflation may be higher, and unemployment may be higher. The economy may grow more slowly. The size of the effects is going to be uncertain. And he says, while tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. So he's dropping the word transitory here. So Powell is making it also clear that the Fed's first goal will be to fight inflation, saying their obligation is to keep longer-term inflation expectations well anchored and to make sure that a one-time increase in the price level does not become an ongoing inflation problem. They're well positioned for whatever happens, but he says it's going to take time to be able to figure out exactly what the impacts are going to be.
There is the bind. Inflationary pressure, but trying to stabilize an economy, and the market already pricing in 4 rate cuts. Does that get pulled back when they start to see his voice about inflation?
It may, yes. So we may see that move. It'll be interesting to see what the overall markets do given where they are, because he's basically saying if the economy slows, we're going to let it for the time being. We're going to keep an eye on inflation, and we think inflation could be worse than we had forecast because the tariffs are higher than we had thought.
What's interesting is President Trump himself has been talking about Jay Powell, saying he's always late, but this would be a good moment to cut interest rates. We know where the White House position is on all of this. And
the Fed chairman is saying, no, you're absolutely wrong. And our first move might be to raise rates if we have to fight inflation. I think that Jay Powell's just starting here, so turn it over to him.
Congress has given us of maximum employment and stable prices. While uncertainty is high and downside risks have risen, the economy is still in a good place. The incoming data show solid growth, a labor market in balance, and inflation running much closer to, but still above, our 2% objective. After a couple of years of solid growth, many forecasters have anticipated somewhat slower growth this year. The initial reading for first quarter GDP will be released later this month. The limited hard data are consistent, though, with a slower but still solid growth outlook. At the same time, surveys of households and businesses report dimming expectations and higher uncertainty about the outlook. Survey respondents point to the effects of the new federal policies, especially related to trade. We are closely watching this tension between the hard and the soft data. As the new policies and their likely economic effects become clearer, we will have a better sense of their implications for the economy and for monetary policy. Looking across many indicators, the labor market appears to be broadly in balance and not a significant source of inflationary pressure. This morning's jobs report showed the unemployment rate at 4.2% in March, still in the low range where it has held since early last year. Over the first quarter, payrolls grew by an average of 150,000 jobs per month. The combination of low layoffs, moderating job growth, and slowing labor force growth has kept the unemployment rate broadly stable. Turning to the other leg of our dual mandate, inflation has declined sharply from its pandemic highs of mid-2022. It has done so without the kind of painful rise in unemployment that has often accompanied periods of tight monetary policy that are needed to reduce inflation. More recently, progress toward our 2% inflation objective has slowed. Total PCE prices rose 2.5% over the 12 months ending in February. Core PCE prices, which exclude the volatile food and energy categories, rose 2.8%. Looking ahead, higher tariffs will be working their way through our economy and are likely to raise inflation in coming quarters. Reflecting this, both survey and market-based measures of near-term inflation expectations have moved up. By most measures, longer-term inflation expectations, those beyond just the next few years, remain well anchored and consistent with our 2% inflation goal. We remain committed to returning inflation sustainably to our 2% objective. Turning to monetary policy, we face a highly uncertain outlook with elevated risks of both higher unemployment and higher inflation. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Our monetary policy stance is well positioned to deal with the risks and uncertainties we face as we gain a better understanding of the policy changes and their likely effects on the economy. It is not our role to comment on those policies. Rather, we make an assessment of their likely effects, observe the behavior of the economy, and set monetary policy in a way that best achieves our dual mandate goals. We have stressed that it will be very difficult to assess the likely economic effects of higher tariffs until there is greater certainty about the details, such as what will be tariffed, at what level, and for what duration, and the extent of any retaliation from our trading partners. While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain. While tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent. Avoiding that outcome would depend on keeping longer-term inflation expectations well anchored, on the size of the effects, and on how long it takes for them to pass through fully to prices. Our obligation is to keep longer-term inflation expectations well anchored and to make certain that a one-time increase in the price level does not become an ongoing inflation problem. We'll continue to carefully monitor the incoming data, the evolving outlook, and the balance of risks. We're well positioned to wait for greater clarity before considering any adjustments to our policy stance. It is too soon to say what will be the appropriate path for monetary policy. We understand the benefits of a solid economy where workers can find jobs and inflation is low and predictable. We also understand that elevated levels of unemployment or inflation can be damaging and painful for communities, families, and businesses. That is why we at the Fed will continue to do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Most importantly, thank you for being here. This feels like quite a moment to be speaking with you, and I want to thank you for your time. He's got it. I want to thank you for being here, and thank you for taking the time to speak with this group of business journalists. Also like to give a special thanks to Heather Long with the Washington Post, who helped make this event possible. So for starters, sir, how's your week been?
Just fine, thank you.
Care to elaborate?
So far, so good.
Chair Powell, yes, thank you so much for being here and taking our questions. You were talking about the economy as being a very strong economy. You characterized inflation as coming down, employment as being very strong still. However, President Trump earlier this week, when asked about the market volatility we've been seeing, said the volatility was, quote, to be expected. This is a patient that was very sick. We inherited a terrible economy. A lot of voters did and do agree with that assessment, or at least in part. I'm wondering how you would respond to that assessment and the disconnect between the story of the data and the way a lot of people are feeling about the economy.
Sure. So let me just be clear at the start. I make it a practice not to respond to any elected officials' comments. So I don't want to be seen to be doing that. It's just not appropriate for me. But the situation, I think, is this, and people, when they're surveyed, they are unhappy about the economy. That seems to largely reflect the increase in the price level that happened when inflation was high, 2021, 22, and 23, largely. Inflation is now back down to much more normal levels. Unemployment is low. The economy has been growing, but people are still experiencing that high price level. In other words, prices don't go down. They know they're paying much more for the basic necessities of life. And they're right that they are, and they're not happy about it, and they're right not to be happy about it. So I think that accounts for the negative sentiment. Of course, we're looking at inflation, which is the change in prices, and we're seeing that has come down quite a bit, and that, unemployment is actually low. It's sort of very close to measures of maximum employment, and the economy's growing. So all those statistics are good, but the price increases of the past few years are weighing on people's budgets.
So I'm from Milwaukee, and I've been talking to business leaders, executives, and consumers in our community, in our region, for the last few weeks, mostly before this week's news. Chairman, they're troubled and they're nervous. One business owner told me, if there's a hint of a recession, we're cooked. And he asked me to share that with you. What's your response?
So I guess I would say, let's start with the fact that the incoming data right through this morning's employment report, which admittedly is from roughly a month ago, the week of March 12, they took the data, and it still shows us a solid economy. Unemployment's still low. I understand the uncertainty that's weighing on people. You ask about a recession. We don't make a probability forecast of how likely it is for there to be a recession, but many outside forecasters do, and many of them have raised the likelihood, albeit from very low levels. It's not something that anybody now is forecasting, or some people are starting to. And so there's not much more I can say about that. I realize that the uncertainty is high, what we've learned is that the tariffs are higher than anticipated, higher than almost all forecasters predicted. We still don't know where that comes to rest, though, and we're just going to have to see that through.
At a congressional hearing last year, one of the U.S. representatives said that you were pretty boring, and you thanked him and said that you considered that a very high compliment. And in fact, I feel like it's one of the roles of the Federal Reserve, especially since the housing crisis, to be kind of a ballast, especially in the face of the volatility of the markets and the dramatics that we can experience with the economy. Very steady, no surprises, very reliable. In a moment like this, which also has a lot of drama and unpredictability, but it is not necessarily from an economic crisis. It's by design, it's political. How do you see your role in this moment?
So I think all of the values that you touched on are, in fact, the values that we try to live by. We're driven by, analysis and careful thought and discussion and debate and the merits of things. We try to stay as far as we can from the political process. We don't look at political cycles or things like that. And I think people expect that from us. They expect us to tell the truth, and that's what we're going to do. But at the same time, we don't want to be part of the broader political discussion about the wisdom of policies that are not assigned to us. We're not responsible for trade policy, immigration policy, fiscal policy. So we don't comment on those. Decisions are made by others, and what we do is we use our tools to try to achieve the goals that Congress assigned us, which is maximum employment and price stability. So I like to think that over time we're a source of calm, rational analysis and also of stability. That's really what the business that we're in is, providing financial and macroeconomic stability to the public. That's really our purpose.
So how can businesses and individuals and the Fed make plans for the future when so much is being dictated by the actions of a single person? And do you see yourself as the consoler-in-chief on economic matters?
No, I think, take a step back. What's happening is, as I mentioned, the new administration is making significant policy changes in trade, immigration, fiscal policy, and regulation. And you're still just a couple of months into the administration, and that process will take place. And at a certain point, the new policies will be on the table. They will be having the effects they're going to have on the economy, and uncertainty will decline. Right now, there's a lot of uncertainty about where all that's going to sort out, the forms it will take, and what the economic effects will be. If you fast forward a year from now, the uncertainty should be much lower. The actual effects of the policies should then be pretty manifest and clear. So I think I understand why it just is highly uncertain, both what the policies will turn out to be, exactly what they'll turn out to be, and also what their effects will be in the near term. We just have to go through that process, and it is just kind of a manifestation of our election cycle and a new administration coming in with new policies.
I mean, given all of the change happening and the fact that we are in a period where things have not settled in yet, and that the Federal Reserve and you as chair are very projection, data-driven, policy-driven, how do you handle a moment like now? I mean, can you tweak your plans and projections? Do you just do you have to reset them?
So, what we've had since in the last few months is, from the staff, has been a placeholder. Rather, they wouldn't call it a forecast because it's so uncertain. They call it a placeholder. And that's kind of how we've been thinking about it. So it's a good time to take a step back and let things clarify. That's why it's just too soon to say what the appropriate monetary policy response will be to these new policies. It is just too soon to say. We can't say with any confidence today. So that's what we're doing. We've taken a step back, and we're watching to see what the policies turn out to be and the ways in which they will affect the economy, and then we'll be able to act. Fortunately, our policy stance is in a good place for us to do that. We're probably moderately restrictive, let's say, so it's not really tight policy, but which is appropriate since inflation is a bit above target. So we think we're well positioned to address whatever may come. And in the meantime, I'd say we're waiting for greater clarity before we consider adjustments.
Business owners in Wisconsin have told me that they can't make their plans. They want to expand. They want to build a new facility. They want to hire or do whatever the future calls for. They say, we're trying to look around the corner. We're not even sure where the corner is, and we're not even sure what's around the corner. Sounds like they're in the same position as you are a little bit.
No, we hear the same thing. Of course, we have an incredible network of contacts with businesses and also universities, nonprofits, all different sectors, through the Reserve Banks and also through the Board of Governors. And that's what we hear. But again, it's a process. We're going through it, and I think we will know when we know what the policies are exactly and what their implications will be for the economy. That will all become clear, and I think that'll be a time when people can make decisions. In the meantime, though, I get it. We're hearing that a lot from people, and we are kind of in the same place, which is waiting for clarity about what our policy path should be.
It might be months away.
We'll have to see.
Yeah.
As you're talking about placeholders right now and having something in the place when there's so much that we don't know, it does occur to me that this is not the first economic shock that you have steered the markets and the economy through. Obviously, there was COVID almost exactly 5 years ago. It seems similar in certain ways with a lot of uncertainty, a lot of shock, also potential disruptions to prices and to supply, which is very much in the Federal Reserve's wheelhouse. I mean, from where you sit, can Liberation Day be compared to kind of the economic effects of COVID? Are they totally different, somewhat related?
I think each situation is different. There was COVID. There was also then, in the response to COVID, then there was high inflation, and then there was soft landing, and then and now we have new administration and changes in policies. And every situation, it kind of rhymes, but it's not exactly the same thing. And so in this situation, what we face is what I mentioned in my remarks, is you actually have risks for higher unemployment and higher inflation, and that's difficult for a central bank because our tools, which consist of interest rates, either slow down or speed up the economy over time. And higher unemployment would call for speeding up the economy, and higher inflation would call for slowing it down. So you can be in a situation, if we find ourselves in that situation, we look at how far each of the two variables is from its goal, and we ask ourselves, how long would it take to get back? And we weigh those things and make a decision about what to do. But there's no question that's a different situation, very difficult situation. When we faced high inflation, it was painful for the country, painful for the people that we serve, but we knew what policy needed to be. We knew we needed to raise rates quite a bit. During the pandemic, we knew what we needed to do. It was very clear the direction that we needed to take with force, and we did.
It's almost a situation potentially where the dual mandate is at odds with itself.
The two goals are, as we say, in tension, or they may be. I'd say that's not what we're seeing right now, but it's the effects at the margin right now would be for higher inflation and perhaps higher unemployment, but that's a marginal effect. I would say you're not in a situation like we were in the 1970s where the two goals were really both pulling in opposite directions and required. It's just very hard for a central bank to be the answer to a situation like that. But that's not the situation we're really in today.
One of the questions from the audience that we had is, if unemployment takes off and inflation takes off, which lever do you go for? Which lever do you, what do you do?
So we actually have we have a document called our consensus statement, or the longer version is Statement on Longer Run Goals and Monetary Policy Strategy. And the 6th paragraph of that actually contemplates when the two goals are in tension. And what it says is, think about how far each variable is from its goal, and think about how long it would take for each to get back. So in a way, it's an equation. You're comparing two quantities which each have two variables. And then you say, you look at that and you think, what do we need to do? And typically this doesn't happen very often, but if one of them is further away, then you would focus on that one. In the case of high inflation, they actually both pointed in the same direction. The labor market was overheated and inflation was very high. So both of those called for tight monetary policy. This could be different, but again, we're not actually facing that today.
I feel like there's another tension inherent in your job, which is that you're looking at the macro economy, at the global economy, really, and the U.S. places in it, but also the data you're looking at is very profoundly human, as Jim has been pointing out. Jobs, I think, and prices are probably the two most human pieces of data, and certainly in our day-to-day experience, probably the things that loom the largest. How do you reconcile those two things when you're looking at the data, like both the global markets and knowing that the data represents a lot of lives and jobs and egg prices and things like that?
So I think at the Fed, we always keep a focus on the people that we serve, and we know We know and are very conscious daily that the things that we do have a real effect on people's lives. We know that, and it really does focus the mind. And I think if you talk to people at the Fed, there's a very strong commitment to serving the public as well as we possibly can. Economic events are just very, very unpredictable at times, and there are shocks that you can't see coming. But nonetheless, our job is to, whatever happens, use our tools to bring the economy back to stability, back to price stability, back to maximum employment. And that's what we do. But you're right. We try to keep everybody in the room with us when we're thinking about what to do.
So in response to the last round of tariffs, Harley-Davidson, which is based in Milwaukee, moved some production to Thailand. Now the company might be whipsawed again by the new tariffs. It could be really devastating for sales, for employment, for the future of that company. But a lot of companies are in that same position. And what do you say to companies like Harley-Davidson and their workers?
So it just isn't, I really want to stick to our knitting. I mean, we have this great thing called our independence of monetary policy, and that's critical for us to be able to do our job. But for us to keep that independence, we need to not succumb to the temptation to want to be a player on issues that are not assigned to us.